Many of us have heard about value investing, and one way to do it is to buy undervalued stocks. But what are these stocks? How can you know about them? Let's find out. Undervalued stocks are stocks that trade below their assumed value. They often have a track record of being profitable and the potential for long-term growth, but the stock market hasn't recognized that yet. These are 6 of the most undervalued stocks to buy in the technology, media, and telecom, or TMT fields. Some have recently taken a dip as a result of lower guidance related to the economy and shipping-related delays and cost increases. These TMT stocks all have good earnings prospects, and indeed, several of them are producing huge amounts of free cash flow, or FCF. FCF allows these stocks to pay dividends and or buy back large amounts of shares. This has the effect of increasing dividends and earnings per share, or EPS, lowering the valuation and making the stock more attractive. The constant buying also helps push up their stock prices. Let's dive in and look at these stocks. Number 1, AT&T, ticker symbol T. At the moment, AT&T's market value is $150.23 billion. After spinning off its Warner Media division, which included HBO and the Warner Brothers studio, AT&T is now a respectable wireless communications corporation. Analysts now predict that it will generate $122.6 billion in sales in 2023. That only amounts to 1.25 times the sales. Additionally, AT&T stock, which closed at $20.98 on June 6th, is only trading for 3.63 times the projected EPS of $2.52 for 2023. AT&T pays a $1.11 dividend, giving the company an extremely alluring yield of 5.31%. The stock is particularly appealing as a result of these two considerations. AT&T is using its cash flow to reduce debt and control its core business and margins. That'll assist in bringing the stock closer to its true worth. For instance, AT&T's stock may increase by 57.2% for 12 times earnings. The median price objective for AT&T Inc. from the 19 analysts providing 12-month price projections is $22,000, with a high estimate of $26,000 and a low estimate of $10,000. From the most recent price of $17.88, the median projection reflects a rise of 23.04%. 2. Verizon Wireless, ticker symbol VZ. Verizon has a current market capitalization of $214.5 billion. Here, Verizon appears to be an excellent deal. In summary, the wireless communication stock trades on a forward P/E ratio of just 9.1 times and offers a dividend yield of 5%. Additionally, the business can pay its respectable $2.56 dividends. That amounts to well over half of its anticipated 2023 earnings, or 45.8%. Additionally, it results in a very alluring dividend yield of 5.04% for VZ stock. Despite significant capital expenditures, the corporation generated $1 billion in free cash flow as of the first quarter. In the future, this might experience pressure if revenues don't increase by $3 billion in 2023, as experts predict. However, if they do, this can be among the greatest defensive stocks, particularly if the business decides to keep paying a dividend. Number 3, Alphabet Google, ticker symbol GOOG. Alphabet has a current market capitalization of $1.45 trillion. We may not know Alphabet, but we are all familiar with Google, which is a project of this company. In comparison to a year ago, Alphabet's first quarter sales increased by 23%. The market was worried about a slowdown in the growth of ad revenues because this was lower than the 34% growth rate from the previous year. For long-term investors, this has presented a fantastic opportunity to buy at a discount. For instance, analysts now forecast EPS growth of $111.43, or 18.8% through 2022. This places GOOG shares on a cheap forward P/E multiple of only 17.2 times for 2023 at $2,346.70 per share as of June 6th. That's significantly less than the company's typical 5-year future P/E multiple of 26.5 times. That increases its inherent value by 54% compared to its existing 17.2 times multiple. Despite not paying a dividend, Alphabet more than makes up for it with significant share buybacks. For instance, Alphabet generated nearly $15.3 billion in FCF in the most recent quarter. However, the corporation repurchased shares for $13.3 billion. In other words, rather than just adding to the company's balance sheet, the majority of its free cash flow was used to reduce its share account. Its earnings per share increased as a result, driving up the price of the stock. Buybacks amount to about $53 billion annually, or 3.54% of the company's market value. In 3 years, if the stock remains flat, its share count would decrease by more than 10%. That alone ensures a greater cost. 4. Microsoft Corporation, ticker symbol MSFT. Microsoft's current market capitalization is $2.01 trillion. Microsoft just reduced its predictions for the future. Microsoft reduced its revenue and earnings forecast for the June 30th fiscal fourth quarter. Nevertheless, this results in an increase in EPS of 16.9% from $8.5 to $9.32. Analysts also forecast $10.74 in earnings, a 14% increase for the fiscal year ending in June 2023. Even with reduced guidance, many businesses would kill to have these types of expectations. MSFT stock is inexpensive at $268.75 as of June 6th, with just 23 times projected earnings. However, the technology company also generates a significant amount of FCF. It produced nearly $25 billion in FCF in the most recent quarter. Accordingly, it had a 100% FCF margin on its quarterly revenue. Additionally, that will more than cover the $8.8 billion in share buybacks it made during the previous quarter. In terms of share buybacks, that equates to $35 billion yearly, or 1.73% of the company's $2 trillion market value. In other words, this is one of the best TMT stocks to purchase now that it is cheap. 5. Autodesk Inc., ticker symbol ADSK. The market capital of Autodesk is $45.14 billion US. The four divisions of Autodesk's software and service activities are manufacturing, media and entertainment, AutoCAD and AutoCAD LT, and architecture, engineering, and construction, or M&E. The company provides AutoCAD Civil 3D, a system for surveying, designing, analyzing, and documenting civil engineering projects. On May 27th, following the release of the software company's fiscal year 2023 first quarter data, Autodesk's 5.62% stock price increased by 10% for the period that ended April 30th. Its quarterly earnings of $1.17 billion, up 18% year over year, were $20 million higher than experts' expectations. Its adjusted earnings rose 39% to $1.43 per share, above expectations by 9 cents. Through the epidemic, Autodesk was able to maintain steady growth thanks to its cloud-based services. For the second quarter and the entire year, Autodesk anticipates revenue growth of between 15 and 17% year over year. The suspension of its services in Russia will result in a $40 million or 3% of its sales decline in that estimate. In a report published on August 24th, Oppenheimer analyst Kenneth Wong maintained a buy rating on Autodesk with a $255 price objective. The closing price for the stock was $214.43. Autodesk now has a strong buy analyst consensus with an average price target of $260.86. In the near term, the stock is in the middle of a broad and powerful rising trend, and a subsequent rise within the trend is anticipated. Given the short-term trend, it's anticipated that the stock will increase by 20.65% over the next 3 months, and with a 90% likelihood remain in the range of $237.40 and $289.56 at that time. Number 6. Qualcomm Incorporated, ticker symbol QCOM. Qualcomm is the main pioneer in wireless technology and the driver behind the creation, introduction, and growth of 5G. In the fiscal second quarter that concluded on March 27, 2022, which also happened to be the first quarter of the calendar year when smartphone sales had declined by double digits, Qualcomm had produced tremendous growth. In fiscal Q2, Qualcomm's revenue increased by 41% year over year, thanks in large part to a 56% increase in revenue from the handset industry. The company's performance earlier this year was unaffected by the sluggish smartphone market. That's because Qualcomm asserts that its relationships with significant smartphone clients like Samsung have grown, and its solutions are also becoming more popular among Chinese smartphone OEMs. On April 28th, Qualcomm shares increased by almost 10% as a result of strong earnings, but ran into resistance at the 50-day moving average. The price of the QCOM shares as of August 26, 2022 was $138.38. The price of QCOM shares has dropped 6.2% in the last 5 trading days compared to a 2.81% drop in the previous year. QCOM is now down 24.3% in 2022. Qualcomm Incorporated ranked 99th out of all companies in the semiconductor sector, with a market value of $164.2 billion as of August 26, 2022. The price-to-earnings ratio for Qualcomm Inc. is currently 12.3. The trailing 12-month sales for Qualcomm are $42.1 billion, with a 30.5% profit margin. The most recent quarterly sales rise over the prior year was 35.7%. For the current fiscal year, analysts forecast adjusted earnings to be $12.54.5 per share. Currently, Qualcomm's dividend yield is 2.2%. This ends the video for today. Like, share, and subscribe to the channel if you find the video informative. See you next time.